Welcome, everybody. In this presentation, we're going to bring to you what's happened in the markets, broadly speaking, and indeed how your portfolios have performed, not just over the past quarter, but also over the past year as well. So this is our first screen here. You can see the nice, shiny front page. It says September quarter review. We have given it a theme of no place to hide. You'll understand what I mean by that. But before I get started, let me just start off with the disclaimer. Obviously, the opinions mentioned in this video are of general information in that nature. Any personalization of the content discussed in this presentation, obviously in due course you will have that discussion with Mick Stefan at Independent Advisors. Moving on to just a quick introduction. Obviously I've gone straight into presenting and I haven't even given you my name and who I am. So my name is Max Riaz, and joining me today is Zach Riaz, and we've got a number of other people that support us in portfolio management. So we are effectively your portfolio managers within Independent Advisors, and our job is to look at the markets, research stocks and manage funds, build portfolios for the clients of Independent Advisors and manage those portfolios. Okay, let me start off with how the markets have performed over the past year. And these are numbers as at 26th of September. I'll start off with the equities, i.e. shares. This is just a global view of how the share markets all over the world, advanced economies and emerging markets, as they say, which are mainly Chinese and Indian and Korean markets. But as you can see, there's red everywhere. And that's the sort of obvious thing that you can pick up from this table. Right at the top, you've got Dow Jones Index, which is Dow Jones and the S&P 500. They're the two American indices that you can see they're down about 14 or 15%, 17%, 1 year rolling to around about the end of September. And then as you work your way down, you've got the European indices, FTSE 100, the DAX in Germany and France. They're down about 21%, 14%, double-digit numbers effectively. So all the way down to the Asian markets, they've had a much worse sell-off. We've all been hearing about what's been happening in terms of the energy crunch in Europe. But if you look at the Asian markets, such as the Shanghai Composite, the Chinese market, that's down about 15%, but the Koreans are down about 26%. Taiwanese market is down about 18% and so forth. Then most client portfolios also tend to have bonds or credit. You can see here as well, across all the major bond markets, they're also down in double-digit numbers. Global bond funds are down about 13%. But if you sort of go into individual markets, Canadians, French, German, UK, they're down between 15, 16, 20%, if not more. So now you understand the initial sort of theme line that we introduced this presentation with, that is no place to hide. So if you've got bonds, clients have been affected there. And if you've obviously got shares in your portfolios, people have been affected as well. So no place to hide. Bringing that global view into how your portfolios have traveled as at 31st of August. So these are 3-month numbers and 1 year numbers. These are the 5 major risk profile based standard portfolios that Independent Advisors manage. Some individual client portfolios may vary a tad around these settings, but broadly, this is what your numbers are going to be in line with. On the 3-month basis, your portfolio is down over the 3-month period, down about 2% across all of those risk profiles. And on a 1 year basis, you can see the numbers are somewhere around 11 to 12% down. So broadly, as you can see, the sell-off in the bonds and also the shares are of sort of equal magnitude, and it's reflected in the yearly numbers. I've just put Vanguard's equivalent ETF-based, the similar risk profile-based portfolios offered by Vanguard, they're about similar, sort of down about similar magnitude. Now, these are just short-term numbers, but it just gives you a quick snapshot of how the portfolios have traveled within the independent advisors fold. Looking forward, I just want to quickly touch on, we've made some slight adjustments, but before I talk about the adjustments we've made to your standard portfolios, I just want to quickly remind ourselves and the audience here that are listening to this and watching this video, that we're managing your portfolios with the mandate of seeking to strike a balance between financial return and also making sure that financial return is done responsibly by investing in managed funds or ETFs that are through sustainable objectives. So making sure that those fund managers are not allocating capital into industries and sectors that are impacting the environment or other social imperatives such as diversity and gender equality and that type of thing. So that's the overall mandate for your portfolios that we observe, and we go on from there. So I'm going to now call in Zach Riaz, and I'm going to get Zach to just chime in and talk about what adjustments just quickly we've made in the portfolios looking forward, and then I'll come back on. Thanks, Zach.
Yeah, thanks, Max, and good day, everybody. Look, so the following, we've just made some key changes to the portfolio. They're not drastic changes, but changes that we feel are appropriate given the environment we're likely to see over the next 2 to 3 to 5 years. And I guess the biggest change to call out is we reduced the overall duration of the portfolio. Some clients may question why reduce the portfolio duration or bonds, given the reset in bond yields already. It's the simple fact is we believe there could be further upside risk to yields from here. And given that the defensive side of the portfolio needs to provide some sort of capital stability, what we've decided to do is add alternatives to the portfolio, which hopefully give us a more uncorrelated returns to bonds and equities. So the biggest change has been reducing the defensive part of the portfolio from bonds into alternatives. The other key point changes we made is just up the cash a little bit more, just to provide a little bit more capital stability to the overall portfolio. That's specifically very relevant for the more conservative profiles. So we feel a little bit more of cash on hand is probably warranted in the current environment. And we certainly believe the next 6 to 12 months will probably give clients an opportunity to deploy cash at much healthier, at probably more attractive valuations. And the final changes we would make is we've slightly balanced out within the growth component, we've balanced out the exposure to Australian equities and global equities. We all know the challenges that the global economy is facing. Australia, whilst not without its own challenges, is better placed. And so what we've decided to do is just balance out the exposure between Australian and global equities. The other point that would note, by doing that, we're also reducing our exposure to the movement into the Australian dollar. So the more in Australian dollar, given where the Australian dollar is trading right now, any upside risk to the Australian dollar relative to the US dollar means we're effectively hedged from that risk. So those are the key changes we made to the portfolio.
Thanks for that, Zach. Just touching on duration, just for those sort of not familiar with that term, is what we're effectively saying is we're not lending money out to, whether it's corporates through the portfolio, through corporates to corporates or governments on a, let's say, 5-year basis or 10-year basis, because we just don't know where the inflation will go, and the current level of return being generated on those securities, given those uncertainties longer term, we don't feel that we need to invest on that longer term basis. So we're sticking to shorter maturity debt financing is effectively what we're referring to there when we talk about duration. Thank you, Zach. So moving on to just rounding off outlook wise, looking forward next year or so, a couple of years maybe as well. And we'll come back to you every quarter and give you an update on how we're seeing the market. But right now, as we stand, The outlook for the market is that expect volatility in shares and bonds. We've had a decent sell-off already. Aussie equities are down about 15%. There might be another 5% from here on, and that would be reflective of a recessionary environment. And bonds are largely there. There's probably another quarter of downward, last quarter of downward draft to go in bonds. In terms of companies that are held through your funds, largely they're in good balance sheet positions, got good solid cash levels on them, and they're able to continue paying dividends. And right now, when the markets are uncertain, investors tend to look for the safety of cash and dividends, and companies that have got good levels of dividends will get supported, and that should support the returns coming back through to the shareholders. And the valuations, as I said, markets are down about 15-20%. They're a lot cheaper than they were, obviously, a year ago. Valuations are looking attractive, and this is just part and parcel of what markets do. They take 2 steps back, and then they take 3 steps forward, or take 1 step back and take 2 steps forward. So it's just the volatility is the price you pay to generate returns over a long period of time. So that is where I wanted to end this conversation and update. And we look forward to, both Zach and I look forward to seeing you next time. Until then, bye-bye.